Hello everyone. I thought the FLCT's first half 23 numbers was a bit of disappointment. I think there's a decent drag from the commercial portfolio. So let's talk about it. So this is the share price performance. Actually, the performance has been really good for the past 6 months. In terms of my portfolio, this has given me actually very good gains this year. The regret, of course, is that I didn't buy anything last year. But I was buying other things other than this stuff because this is actually quite a heavy component of my portfolio. So I didn't buy anything over here. Looking at the share price, it rallied to like 136, and then quite strangely on the 14th of February, the CEO announced his resignation, and then the markets took it really badly, right? I think collapsing from 135, 136 all the way to 124, 125. I was surprised though. Surprised that the markets regarded the CEO so highly. Of course, I think he's really competent. He really drove the REIT to new heights, and look at the quality of the management. It's fantastic. So I think the CEO has been excellent. But nonetheless, I'm surprised that the markets took it so badly. Because ultimately the assets matter the most to the REIT, and the assets are still quite quality. But nonetheless, you can see that post the sell-off and so on and so forth, the market actually recovered, and the share price reached 135, 136. I thought the numbers were quite disappointing. So after that, I just sold all my holdings at the 135 subsequently. At these price levels, I thought the DPU wasn't impressive and the prices are a bit rich. So I took profit, given that especially I don't have a very good feel of, or actually I have a rather downbeat feel for the REIT market going forward. I think the Fed will be keeping rates higher for longer, and the market is just completely wrong in thinking that they're going to cut rates aggressively for towards the later half of this year. So I think I'm quite downbeat on the REIT sector in general. So I just took the opportunity to sell everything. But I guess if you look at the fundamentals, it's quite good actually. It's not that bad, I would say. DPU is down 9% from last year, but then last year it comprises of this early surrender fee from Farnborough, right? So if you consider that together with the fact that the FX has really performed really badly against a very strong Sing dollar, so the Aussie dollar, the cable, and the euro all falling against the Sing, right? So actually the DPU is quite in line with expectations, but nonetheless, with first half DPU of 3.5 cents, the full year DPU is probably going to come in at 7.1, 7.2, so on and so forth. So the DPU yield at this level is just about 5.1, 5.2, 5.3%, which is not that interesting. But I guess if you're conservative, it's also acceptable because the leverage is very low, right? Just 28%. It's probably one of the lowest, if not the lowest in the S-rate space. So I'm a bit of two minds about the valuation of this REIT. It's safe, yielding 5+%. But then you can get the other stuff which more leverage, yielding around 7%, right? So I think it's really up to the investor and the risk appetite. But for me, I'm a bit of a risk taker, so I chose to move on. The portfolio leasing numbers was not that surprising, especially for the logistics and industrial segments. So look at the reversion numbers, up 24% for Australian L&I properties. Not surprising at all if you follow the numbers from AIMS, APAC, and Ascenders REIT. So this is fully in line with expectations. I think the commercial portfolio though is a bit of concern, which was one of the reasons why I sold everything. So first of all, we have the ATP in Singapore, right? Google announced that they're gonna be surrendering their lease in stages. And ATP occupies 10% of the portfolio, right? So I think Google occupies like 40+% of this property. So there will be an income gap once they vacate. I think they should be able to backfill the space, given that it's still not a bad property in Singapore. But the backfilling will take time, and I'm not very sure about the rental rates either. But I'm not that concerned about this stuff. I think it's okay. I'm more concerned about the UK business parks though. Because the occupancy, 66%, 78%, 83%, not really that high, right? I'm starting to think that the Brexit effect on the UK economy is more severe than what the people thought. In fact, if you look at the news, there are some people agitating for a reversal of Brexit, which I think is a complete nonsense, right? the people have spoken, they voted for Brexit, so you accept it and move on, right? But I think the people are now slowly recognizing that the effect on Brexit on UK is not as small as what they thought. So I'm not very sure though. It's a lot of uncertainty for me. Also, in terms of acquisition, now that they sold the Singapore property at Cross Street, are they gonna buy the rest of the portfolio from the sponsor? In terms of the UK business parks. So I think all the uncertainties make it rather unsure for me, especially for this segment. For the commercial properties in Australia, I'm also concerned about the WALE. So for Caroline Chisholm, it's 2.3 years of a WALE, and for 357 Collins Street, it's 2.2 years. I'm also very concerned about the work from home scheme for commercial properties. In general, I'm skeptical about the commercial properties for all over the world, except Singapore. I think for Singapore, I have nothing to worry about. People work from home is not gonna destroy Singapore offices, especially in prime CBD and Marina Bay area. So, but then other than Singapore properties, I tend to be more skeptical about the commercial properties all over the world, especially in the West, especially in the US, especially. I wouldn't touch US offices with 400 feet pole, man. But nonetheless, this stuff is a bit of concern for me. So, looking at the lease expiry profile for the commercial properties, a bunch of stuff are expiring in 2024 and 2025. In Australia, you can see here, and I think for Singapore is Google, ATP. So I'm not very sure though. What will happen to these properties? And is because some of these stuff are master lease, right? Can they find replacement tenants fast? And what will be the rental rates on finding new tenants? So a lot of uncertainty for me. So for me, I need clarity on the commercial portfolio before I'm willing to commit the capital. So therefore, I chose to sell everything and move into cash. I think there are better opportunities elsewhere in the market, especially when I'm not that favorable on the market's view on the Fed's rate hike course going forward. I think the Fed will be higher for longer, and the markets are completely wrong in thinking that the Fed will cut rates aggressively towards the end of this year. So I prefer to move back into cash and await better opportunities. That's it though. I think this is a very, very well-run reader. I will be back once the price corrects to a more favorable level where the risk reward is in my favor.